Thank you all for joining us here. Obviously, this has been a very tumultuous year. Let's put it that way. If you notice that the title of our presentation is "Life After Tariffs: What You Missed While Obsessing Over Trump." Now, I can't promise you that the words Trump and tariffs, that this will be the last time you see it in this presentation. But it'll be close. We're not going to be talking a lot about Trump or tariffs. Now, there's several reasons for that. One is, to be perfectly honest, we're kind of bored with the topic already. We've been writing and thinking about this for 9 months at this point. Middle last year, we were already like, well, this is probably going to happen once again. So we had to figure out what was going to happen. The second reason is we think we got it pretty figured out. Actually, if you look at our Q1 annual report, I think we have a good sense of what's coming out of the Trump administration and what the effects and impacts are. So if you want to sort of get a sort of rehash of that, just pick up our Q1 report. We called it Nation Over Empire. And I think all those themes are really kind of playing out. And I think that that's what's important. It's not, freaking out, but understanding where the trends are going and where the structural differences are. And really understanding that they go really beyond Trump. Trump is, in our view, just a symptom of the underlying sort of malaise that's going on in the country and in other parts of the world. But not only malaise, because that gives it a negative connotation, just changes, structural changes that were going to happen one way or another. Trump is either just accelerating them or doing them in a certain type of fashion. So I promise you this will be one of the last times you see these words. But the other reason is because there's been a lot of things going on that you may have missed because everyone's obsessing over this. We have tremendous advancements in AI. Microsoft just yesterday said that they've saved $500 million because they've automated many of their call centers. Think about that. That's just one company. And this is happening across the board. One of the contrarian positions you're probably going to hear tonight is that actually U.S. equities are actually pretty cheap, not expensive, which is, I think, a different view that we have that, might be the street consensus. And part of it is because AI is no longer in the future. It's here. It's now. We see it in my team. There's things that we're doing now that would have taken 2 or 3 more people to do a year ago. That's accretive to earnings. The PE, the E is going to go up, which means the PE is going to go down, which is part of the reason why we think markets actually are not very expensive at all. And have a lot more to run, right? But funny enough, we've actually had a natural experiment this week with tariffs, right? Think about this. In just this week, Trump has put 50% tariffs on copper, right? 50% tariffs on Brazil, right? Which, by the way, doesn't make much sense because it's one of the few countries that we actually have a trade surplus with, right? So we actually don't have a lot of leverage in that relationship because we have a trade surplus with Brazil. But let's set that aside for a second. But so you have 50% tariffs on copper, 50% tariffs on Brazil, and you have, threats against Japan and several other countries. And what have the markets done? Nothing. They don't care. Now people are like, well, how can they not care? They don't care the same way that they didn't care about economic data after COVID. Why? Because COVID, if you remember, was a policy-induced market crash or market correction, however you want to call it. Liberation Day was a policy-induced market crash. And once the policy shifted and Trump's constraints were revealed, you were like, uh-oh, I got to change course. That's it. Doesn't matter. Market doesn't care about this anymore. We actually said in the Q2 call that in 6 to 12 months, markets wouldn't care about tariff threats anymore. That actually might be already happening now this week. Been a very benign market reaction so far. But regardless, this is what assets have done since Liberation Day, April 2nd. If you look at the low was April 8th, the NASDAQ is up, and this is as of the end of June. So it's up even more. The NASDAQ is up over 15%. Even the U.S. 10-year, the much maligned U.S. 10-year, everyone's saying, oh, no one wants to buy U.S. Treasuries. US 10 years up since then. The only thing that's down since then is the dollar. And funny enough, or interestingly enough, we think that this trend continues, which is that US equities, US treasuries will continue to perform well, and the dollar will continue to weaken. The dollar, we think, is still structurally expensive. It's a lot less expensive than it was 6 months ago, where it was about 25% overvalued. Right now, it's about 10% overvalued, 10 to 15%. So we still think the dollar has further to go, and we think these other assets have further to go, meaning the dollar still has further to go down, and the other assets still have further to go up. That doesn't mean you can't own one or the other, right? They're not mutually exclusive, but it just means that there is a currency, let's say, play that we need to keep in mind. Now, the other reason why I don't want to focus too much on Trump and tariffs and what's going on right now is because of this chart. For those of you who have seen our presentations in the past, you'll know that I always like to put a chart somewhere in there that has about 2,000 years of economic history. I love economic history because it really gives you a great perspective on things. This is 3,000 years, so this is even by our standards, this is a pretty long chart. And what you see here is that for the 3,000 years of economic history that we have for human beings, we really didn't do much, right? We're in this Malthusian trap where, we grew a little bit and then we had a war and then we, destroyed some productive assets and, the Roman Empire started, reached its apex, then it collapsed and we had the Black Plague and, Chinese dynasties collapsing and the Moguls, and none of it mattered. None of it mattered. For most of human history, none of this mattered. And then all of a sudden, the Industrial Revolution happens, and we're off to the races, right? And really, you can say almost in a way that the only thing that has ever mattered in human history was the British Industrial Revolution. From that point, we go from flat growth, right? Slightly upward, right? Because we have more people, but pretty flat growth, and then boom, exponential growth. And this chart, as long as this chart holds, and we have no reason to think it's not holding, in fact, we have reason to think that the slope is actually becoming even steeper. This is why when you ask, well, what's going to happen to the S&P this year? I'll tell you what I think is going to happen with the S&P. Every other house has their sort of viewpoint on the S&P. Doesn't really matter, because as long as the technological changes that went into this inflection point after the Industrial Revolution, as long as they hold, this stuff is literally going to the moon. This is why it's only a matter of time before the S&P reaches 7,000. Only a matter of time before it reaches 10,000, 20,000, 30,000. It's literally only a matter of time. Now, I know for your clients, it obviously matters if there's going to be a 20 or 25% drawdown in markets. So I'm not suggesting that, well, just put it in equities and goodbye. I know that this is 3,000 years of economic history. Most people's lifespans do not span 3,000 years. So I know that it does matter to get the tactical points right. But always, let your clients know to keep this kind of chart in the background. And know that as long as we have more human beings and technological progress, stocks will go to the moon, so to speak, right? To borrow some of the parlance that's, famous now in the meme industry. So let's now bring it down from 3,000 years. Let's talk about what we think is going to happen this year. So this is our quantitative chart. This is our robot, let's say, that tells us quantitatively what we think the chances of a U.S. recession are in the next 6 months. It's gone up a little bit, but it's at 40% or so. It's actually lower now. This has been updated since we did this chart, but call it around 40%. That's not terribly, it's not enough to make it a base case, but it's enough to at least keep us somewhat cautious and not uber bullish. So this is one input into what is our sort of North Star, which is this that you see here, which are sort of our subjective probabilities for some major risk assets, both the S&P 500, the US 10-year, under different scenarios. So let's talk about our base case. Our base case, which we have it at 55%, so it's how we're operating, it's how we're investing, sees the S&P ending the year between 65 and 6,700, sees the US 10-year at around 4.25, and it sees the effective tariff rate somewhere between 10 and 15%. And this is where we think we're at today. This is the reason why market doesn't care if there's going to be a 50% tariff on Brazil. Because as long as this effective tariff rate stays between 10 and 15%, this is something that the market companies have been able to digest. Yes, US growth will be lower. I'm not saying I'm in favor of tariffs, okay, or that we shouldn't care that they happen. They're lowering the level of growth in the United States, right? US growth this year is going to be somewhere between 1 and 1.5%. We think it's going to be around 1.5%. That's below trend, okay? So it's not a spectacular year, and it wasn't going in that direction, by the way. When we started the year, we thought it was going to be north of 2%. But I think enough damage was done, 1.5. So it's not great, but it's not terrible. That's our base case scenario. What's this Goldilocks scenario? The Goldilocks scenario is where the effective tariff rate falls below 10%. The S&P, can gravitate all the way up to 7,000 or so, and the US 10-year will settle somewhere below 4%. And this is sort of immaculate disinflation because in spite of all the warnings of inflation, and we do know a price bump is coming, we're simply not seeing it in the data. In fact, I would argue that the disinflationary trend has been so strong that despite the tariffs, you aren't seeing this pop up in the inflationary data, okay? And by the way, even if we do have a bump due to tariffs, that's not inflation. Kevin Warsh is actually completely correct when he says tariffs don't cause inflation. They don't. They cause a bump in price. What causes inflation if you keep on increasing tariffs, right? At least that's not what we expect to happen. So typically, it wouldn't even be an argument that the central bank would look through a one-time bump in price increases, which is, by the way, part of the reason why we think the Fed is behind the curve. The Fed should already be cutting rates. We're going to get into that in a minute because I think Trump is actually negotiating against himself because by putting so much pressure on Powell publicly, he's forcing Powell to not cut rates even though he should be cutting rates. And it's going to delay it even further. And now these sort of threats delay that cut, which is why we kind of think that mild recession, 30%, is right about right, because I think that might come because the Fed, kind of as always, might have a policy mistake, right? The Fed always sort of makes a mistake. One of the surest bets to make in a market is to bet that the Fed is not going to do what it says it's going to do. That's one of the easiest ways to make money in the markets. So mild recession, 30%, sees the S&P between 5,000 and 5,200. That's factoring in around 10% cut in EPS estimates. Sees a 10-year at around 375 and the unemployment rate between 5 and 5.5%. And then obviously the most severe scenario, unemployment rate shooting up above 5.5%. That'll see the S&P 45 to 4,700 and the 10-year Treasury between 3.25%. So as you can imagine, we're positioned bullishly. We are positioned for risk assets to continue increasing. Let me bring up, because I see already I said too much in the intro part, and now I need to run through these slides. The fiscal deficit. Let's talk about this because everyone's been, well, what about the U.S.'s fiscal position? It's horrible, yes. It's terrible. There's also no political appetite either from the Republicans or the Democrats to do anything about it. What I think is going to happen eventually is the market is going to force the government's hand and says, no, you want to sell me 10-year paper at 4.25? I don't think so. You're going to sell me paper at 5.25, something like that. When is that going to happen? Who knows? No one knows. Because the market will take paper until it just won't anymore. right? So unless there's a major structural shift, now this could happen 12 months from now, this could happen 6 years from now. No one really knows. There's a famous line in Ernest Hemingway's The Sun Also Rises. They asked someone, so how did you go bankrupt? And it's like, well, the same way everyone does, gradually and then suddenly. And this is how we're going to go bankrupt, right? Gradually and then suddenly, boom. So, but my point is to bring it back here. So 2-3 months ago, we looked at the House bill and we looked at the initial rumblings out of the Senate, and we're like, well, the fiscal deficit's going to be between 7% and 8%. Damn, that's even worse. But now we got the one big beautiful bill, and when you factor in the tariffs, which by the way are here to stay, because what government, and they're going to outlive Trump the same way that Biden didn't remove Trump's tariffs, right? So these tariffs are here to stay, because there's now $300 billion coming into the US government's pockets every year. So good luck getting that off the books. You're looking at a fiscal deficit of 6.5%. So yeah, it's bad. It's not sustainable, but it's better than 7. It's better than 8. So that's why I think the Treasury market has calmed down. Because it's like, okay, well, it's bad, yes, but it's not as bad as we expected. So I don't think this is going to be an impediment to our call on the 10-year, and why we're tactically long Treasuries, even though we do think we're in a structural bear market in Treasuries. We think we've been in one since 2020. I also want to address one other point, because a lot of houses this year have been talking about emerging market equities and how they're so attractive because U.S. exceptionalism is over and no one wants to buy U.S. assets anymore. Not true, by the way. People are selling U.S. assets. Not true. This is not happening. So EM, and obviously this is a broad brush, so I don't want to sort of talk about every emerging market, because we actually think there's like great opportunities in certain emerging markets. But overall, you hear this sort of, well, EM is, let's put money into EM. Well, do you really want to put money into EM? Do you really want to put money into an asset class that has had flat EPS growth for 15 years? So the reason why emerging market equities have not done as well is because they're not as good as making money as companies in other spots. Bottom line. If you look at their EPS growth for the last 15 years, it's been flat. And we know that the long-term driver of earnings, of share prices, is earnings growth, period. That's it. That's the main driver. That's the fundamental driver. The other point I want to make is that EM equities, everyone's, well, they're very cheap. Are they, though? They're really not cheap. Look at them versus other markets. This is on a composite basis. They're not expensive. I'm not going to argue that they're expensive, but they're not cheap. They're about half a standard deviation above sort of trend versus other markets out there. So that whole story that they're cheap, not true at all. Again, that doesn't mean that there aren't some opportunities out there, and there are some emerging markets that we really like, right? Like, we really like Argentina, right? We've liked Argentina for a long time. We think there's a structural, fundamental change happening in Argentina that is a multi-year trend. We're bullish on this country. We actually would use the weakness that we saw in the beginning of the year as an opportunity to add risk if you did not participate in the first wave of the trade that happened last year. So we've been bullish on Argentina for a while now, and we continue to be. But there's other pockets out there. There's Mexico, there's Chile, there's Peru, there's Vietnam, there's Thailand, there's Korea, there's Chinese A shares. We like Chinese A shares. So there are pockets of opportunity. And then there's some markets that we really don't like, right? There's Colombia, Turkey, Brazil, and this wasn't put out there because, of the 50% tariff. That's neither here nor there. I don't even know if that's going to stick. It's almost like we don't really, is it because Bolsonaro is going to go to jail or not? Again, we have a trade surplus with Brazil, so it doesn't make sense to even put a tariff there. But that's not why Brazil's there. We just don't like Brazil for many other reasons, partly because their fiscal situation is terrible and they're not the reserve currency, right? Which we are. We at least get that benefit of the doubt. So I invite you to look at that a little bit more. Another thing I want to talk about is we've been longtime bulls here for gold for a very long time. we think gold, part of the reason that we think not part of the reason, I should say, the fact that we think we're in a structural bear market in treasuries, and we have been since March of 2020. These things tend to last decades. The bull market in treasuries lasted 40 years, the previous one. This bear market is just getting started. Eventually, the 10-year will hit 14, 15% probably again, unless AI comes and just wipes us all out of a job. I say that half jokingly, but could happen. We're telling people, hey, yes, you want to tactically own treasuries because you want to have some ballast in your portfolio, but just have less treasuries and have other things, right? Part of the other things we've been telling people is gold, and we think this will continue to go. I think gold will probably at some point hit 6,000 by the end of the decade. I think it's in a multi-year bull market. People are sort of saying, well, they're at record levels. Yeah, but if you look at gold as a share of total wealth, it's way below historically what it's reached in its peak, let's say in the 1980s. So that's why we're buying things like gold, why we're buying things like Bitcoin, digital assets, commodities. We are putting other things in our portfolios that act as anti-fragile assets because treasuries are not doing the job. They're just not doing the job that they used to. They will help you in the really bad moments, right? If there would have been an Iranian retaliation against the bases in Qatar, for example, or Bahrain, you want to own 10-year paper there. So for those moments, it still really works. But generally speaking, you're going to lose money on a 10-year position over the years. So why, have less of it and have other things out there. So I think, one last point. This is, so the Insigneo Investment Committee always comes, we have our managed portfolios. This is sort of our balanced risk profile. These are the positions that we recommend investors have going into the third quarter. Nothing really stands out. We're sort of near neutral on pretty much everything. The only place, we're still sort of EM underweight on the equity side, partly for some of the reasons I mentioned before. And at least tactically, we're somewhat underweight US a little bit because of the strong move that we have in the United States. But as you can see, there's still 35% of what a balanced risk profile looks like, okay? So, all right, so with that, I will finish my presentation, then I'm gonna pass it along to my colleague, Melissa Ochoa Cárdenas. She is one of our investment strategists who specializes in fixed income, and she's gonna be talking to you about the pendulum swing that we're seeing in Latin America and some of the opportunities that we're seeing out there. So thank you very much.
Good afternoon, everyone. In a year, just as Ahmed mentioned, that we're seeing the American exceptionalism waning, investors are actually starting to look for other pockets of profit, to name it that way, or other places that have been a little bit more resilient, that have offered more attractive returns, where they can actually put their money to work, to just say it bluntly. Enter the Latin American landscape, where the region has actually proved very resilient, even if the political pain points still remain and still are there. So for the remainder of 2025 and the 2026 era that we're about to enter, we should actually focus or monitor very closely what is going on with the political sphere in the region, because we're going to face several elections, and those elections can actually be the main driver of a political pendulum swing, just as the title actually, let's say, gives it away. The first case that I would like to point out is Chile. In Chile, we already had the first, or the left, primary elections. This took place on June 29. And what we had there was actually a victory for a more leftist candidate. Her name is Janet Jara. And she was on top with about 60% of the votes. And even if you would expect markets to have a more negative reaction to a more leftist victory, actually market movements were pretty mute. And this actually leads investors to believe that what's going on is that they're penciling in that the probability of getting a full leftist victory again, let's say to follow Bordick's steps, it's not gonna happen. And however, what we're seeing is that the race for the presidency is actually pretty muted, or pretty fluid, I should say. Fluid in the sense that in the last CADEM survey, we are seeing Janet Jara is leading, but she's leading in a very narrow margin to Jose Antonio Cast, who is the more right-leaning alternative. Remember that he was also a candidate in the previous presidential election. In the case for 2026, we have 3 presidential elections coming. We have Peru, we have Colombia, and we have Brazil. For Colombia, the presidential election is going to happen, or it's going to take place on May 31st. In case that we have a runoff, that runoff is going to occur in June. And the race there is actually pretty open. According to one of the last surveys, or one of the last sources of information that I found, there are over 75 names that are hopefully or supposedly going to present themselves as an alternative for the presidential race. So saying that the race is open is basically an understatement. However, what is happening there? The thing is that we're facing a very challenging macroeconomic environment where inflation remains sticky. The central bank is at odds with the Petro administration. And aside from that, we're actually having pressing or mounting fiscal issues that led to the activation of the exit of the fiscal rule. The activation, of the exit clause of the fiscal rule that eventually led to a credit or a sovereign downgrade of the credit rating. So what we're seeing specifically in Colombia is that assets are starting to price in that the best outcome for this market is going to be a swing of the pendulum. Like if an alternative that is a little bit more right-leaning actually comes into office, is going to be the most beneficial for the Colombian assets in general. And in the case of Brazil, even if elections are more than a year away, because elections are going to actually take place on October the 5th, what has been happening is that the initial surveys that we're seeing are starting to show a statistical tie between current President Lula and former President Jair Bolsonaro. We're also seeing a statistical tie between Lula and former First Lady Michelle Bolsonaro, whereas if the scenarios that we're seeing where Lula is faced, again, a little bit more, let's say, center or right-leaning candidates such as Tarcísio Freitas or Eduardo Bolsonaro, Lula comes out on top. However, these races, we don't even know if they're going to be actually happening, specifically because Lula has been having a lot of health issues, and we also know that Bolsonaro may or may not be able to run for office. You need to also remember that this election is happening against the backdrop of a very challenging macro environment, where inflation in Brazil has been very sticky as well. The central bank has been forced to hike aggressively, and you also need to consider that the fiscal environment, just as Ahmed was pointing out, has been very daunting. Actually, you're seeing the fiscal environment as one of the main drivers for the central bank to hike, which is something that probably shouldn't be the case. So yeah, this is just an understatement or underpinning a very complicated situation. However, one thing that we have been seeing is that most investors are starting to, let's say, position themselves to try and take advantage of a political rally. The political trade that has been mentioned so many times, we are actually seeing it in the behavior of the Latin American assets. What do I mean by that? If we look at the behavior of currencies, for example, as of the close of Q2, the Brazilian real was the best Latin American currency in the quarter in terms of performance. And then the Colombian peso and the Chilean peso were 4th and 5th on the ranking, respectively. If we, however, look at equities, what I would like to highlight is that the US indices for equities, the MSCI for the 3 countries, in terms of total return for the 2 quarters, year to date, closing in Q2, they have been having actually a very stellar performance. Most of them have been at, above, or close to 30% in terms of total return. In fixed income, we have also seen a very positive performance, not as positive as you see it in equities, but what I'm trying to highlight in this case is that investors are starting to basically underpin the idea that the pendulum swing is going to come by just positioning themselves or demanding, if you want to name it that way, Latin American assets. In sum, the main message that I would like to convey to you all is that against the backdrop of very low favorability or very low approval ratings for the 3 administrations of the countries that I mentioned, what most investors would actually think would be the best outcome would be to see a swing or a change in terms of the political direction that the countries are having. So if the markets are actually right, and what ends up happening is that we have a pendulum swing, again, just as the title of this little talk wants to convey, then what we would have is actually an additional space for overperformance, specifically for the Latin American assets. And with that, I want to actually pass it along to my colleague Mauricio Viaud, who is a senior investment strategist and also portfolio manager for us here at Insigneo. Thank you very much.
Good evening. Well, the last 6 months, as Ahmed was saying, everybody's focused on tariffs, but AI kept going. Doesn't wait for anybody. So I have 2 kids in middle school. I used to have more hair before that. They're always into tablets, always. So the other day I was listening to them, and they're telling the tablet, the robot, ChatGPT, what they did in school. And this thing responds saying, "Oh, that's beautiful. What inspired you to do that?" And I'm thinking, oh my God, this thing speaks better than I do. That's how fast AI is evolving. 6 months ago, we were talking about training models, DeepSeek. Now these things are speaking better than some of us. It hasn't waited for anybody. It's kept going. So what I mean by training is basically teaching the model to do basic things through repetition. Think of teaching your kid to do basic math by doing problem after problem after problem. After training, the next level is inference. So when the model is learning to use what it learned through repetition to actually make decisions, solve some problems. So that kid that you just taught how to do math is not in college. It's learning to solve more complex problems. But as if that jump that happened over the last 6, 8 months from training to inference was not enough. Now we're talking about generative AI, Gen AI. The potential for Gen AI is massive. What Gen AI means is basically you're using AI to generate things, to make things. Very basic things. Right now it's pictures, videos. So that the kid that we trained, in math is now making stuff. The potential is huge, though. So according to Bloomberg Intelligence, they estimate that by 2032, the market of Gen AI could reach $1.6 trillion. That's, give you some context, only the largest 15 countries in the world have GDPs greater than 1.6 trillion. So that's massive. The growth, it's going to be obviously very, very steep as well, to the point that it could become 15% of all IT spending by companies. Very, very large potential there. The amazing thing on the spending side of things is that we're seeing it live. We're seeing it happen before our eyes every quarter. Every quarter we see Apple, Microsoft, Google say the only thing constraining AI growth is not demand, it's infrastructure. There's not enough infrastructure out there to meet these needs. So we're seeing these companies pump tons and tons of money into AI to the point that the estimate is that over the next 10 years, spending on AI could reach as much as $2 trillion. Again, massive. A lot of that's going to go into software. A lot of that's going to go into infrastructure, servers. I was just in Virginia recently. Northern Virginia, they have they call it Server Alley. You drive on Route 88, and it's this massive, massive building, one after the other. That's going to keep growing. So you're going to see that growing. You're going to see also increase in energy demand, so increases in investments in energy. Google just came out with their 2025 sustainability survey, and they're saying that in from 24 to 25, the demand growth for electricity grew by 30%. Microsoft, this said, grew by 35%. That's going to keep on growing. So the demand there is so much that some of these companies, some of the utility companies, they're actually avoiding public distribution networks to sell directly to Microsoft, to Google. They're making contracts directly with these companies. They want to get that power ASAP, in the most efficient way. But we haven't only seen changes in software spending, infrastructure spending. We're also seeing changes in hardware. You think about NVIDIA. NVIDIA makes the Ferraris of the chip industry, right? But now we're seeing competition increase from companies like Broadcom, AMD, coming up with cheaper versions, efficient versions. I mean, after all, not everybody needs a Ferrari. Toyota's pretty good every so often. So there's the other options coming out there. NVIDIA hasn't stayed quiet. They've smartened up. I mean, they've always been very smart, but they've upped the ante, if you may, and they're actually creating superclusters. These giant, sometimes a ton worth of chips to run the newest generation or the newest iteration of AI, which is called agentic AI. So what agentic AI is these models that went from training to inferencing to generating. They're now actually able to make decisions for themselves and give advice. So if you think about it, that kid that we trained 6 months ago to do basic math is now giving us advice. That's how fast this thing is growing. That's how fast it's moving in the last 6 months. While everybody was looking the other way, they kept going, never stopped. So they say in the world of parenting, kids grow up in the blink of an eye. In the world of AI, that's very true. So thank you very much. With that, I'm going to have the team come over. We're going to do a Q&A session. Moderator, what plan?
Thank you very much. First of all, thank you for all of you coming here to this event. Not only friendly faces, new faces, friends, we have financial advisors, clients. Thank you so much for joining us for our third quarterly Insigneo call here. So thank you very much. We're here live out of the New York Yacht Club, joined together by Ahmed Riesgo, our Chief Investment Officer. We also have Melissa Ochoa, our investment strategist, and also Mauricio Viaud, our senior investment strategist and portfolio manager. Now, before we get started, a few housekeeping items really quick. First of all, we actually work in a New York minute, and a lot of the meetings, or excuse me, a live view that you've already seen, the content has already been published. So we do work quite fast. We do believe in technology here at Insigneo. And by tomorrow, you will see at our Insights website within Insigneo, you will also see the videos posted under our research tabs. So the second piece is we have a QR tab, so QR code for those of you who are here in person, and also in addition, if you have, for those of you who are live watching us, please ask your question through WhatsApp, and it will be posted here on my phone. And yes, my battery is still running. Thank you so much. So first question, let's get started. Let's see, your recessionary level model suggests relatively low recession risk in the US in the next 6 months. What indicators would you need to change for your outlook to shift towards predicting a recession?
Sure. Yeah, that's a great question. I would say, what we're most focused on right now is the labor market, and the labor market is giving us some warning signs. As I said, I think if Trump could only keep his mouth shut and stop putting pressure on Powell, I think Powell would already be cutting, to be quite honest, because I think there's enough worrying signs in the labor market that it justifies a cut. And the real Fed funds rate has gotten actually very restrictive. Think about it, inflation keeps going down. Fed funds rate stays at 4.5%. The real Fed funds rate in the U.S. is over 2%. So that's quite restrictive. So we'd be looking at the labor market. So, good that we got continuing claims today, for example, that shows a stabilization. So we'd want to, keep an eye on those things. And those things are coming once a week. So we're keeping an eye on the labor market data, really, because that's what, as long as that stays firm, we're going to be in good shape. If that continues to crack, it means most likely, I think what's going to happen is that the Fed, is going to be late, and instead of having to cut one time, they're going to have to do a 2 or 3 cut in one meeting, which I think is what the more they delay this process, the deeper the cuts are going to have to be. I think eventually the Fed funds rate gets to around 3%. So I'm expecting at least 6 cuts between now and the end of next year, I would say.
Perfect. Thank you very much. This question actually, maybe both Ahmed and Melissa, both of you can actually tackle, and you'll see why. Considering the upcoming elections in Chile, Brazil, and Colombia, what strategies should investors adopt to effectively mitigate political risk while capitalizing on potential policy shifts?
I'll let you take that one. That one's pretty tough.
Yeah, talk about easy questions, right?
Right.
We have always tried to maintain an exposure to Latin American issuers, and our stance has always been to try and favor, let's call them fundamental stories. Like, we try to look for issuers in general, in terms of fixed income, that have solid balance sheets, that have shown resilience, and that to some extent are, let's say, insulated to this kind of situations. Take an example, what just happened. For example, it's not necessarily directly tied to the elections, but YPF. We saw the recent crisis as in YPF being tangled with this whole, Jesus, I'm blanking a word, sorry. The court that sued the Argentinian government that is making them give up their participation or their stake on YPF. We actually saw this as an opportunity to add even more exposure to the company because we believe that the fundamentals in that specific company are solid. So having said that, if we look into the specific countries that are going to have elections, we, for example, we added Nutresa recently. That is a Colombian company. They think of it as almost like a Kraft Heinz and Nabisco. They specialize in basically fast-moving consumer goods, mostly on the food side of things. Their fundamentals are pretty solid, even if the fundamentals of Colombia or the story of Colombia, as I mentioned before, is not. So the bottom line of all of this is I would look for specific exposure to stories that I consider are going to have a better development or solid fundamentals in the long run. In terms of currencies, as we said before, we expect that the dollar could continue, let's say, depreciating. And after the announcement of tariffs, we saw that the Brazilian real actually had let's say, it gave back some of the wins that we had mentioned before. However, we are also seeing some stabilization in it. I am not necessarily saying that we should have exposure into all of the currencies, but if the early positioning before the trade, before the elections actually take place, materializes, it should be positive in that sense. For Chile, I would have to evaluate it a little bit more because one of our favorite positions in Chile was SQM, which is one of the copper companies directly related to copper. They are actually having a joint venture with Codelco, which is a national company, and they were trying to extract even more copper and lithium specifically from the Atacama Desert. And the thing is that with this whole 50% tariffs on copper, we need to see specifically how that is going to tackle or how that is going to be managed before actually being able to re-strategize. So again, I still believe that the fundamentals for SQM are solid, but I do also need to consider what's going to happen going forward with this kind of external policy measures, if you want to name it that way. So,
she has a very good fixed income focus list that we've been running for almost a decade now at this point. So have the advisors talk to their clients with those names because there's a lot of good names, which is kind of the point I wanted to make before, which is, it's easy to paint EM with a broad brushstroke, but there's idiosyncratic stories, good and bad, within that space, right? There's a huge difference. between Argentina and Brazil, in our view, right? So lumping them together doesn't really make sense. So I think, these are markets where I think it makes sense to make specific directional bets, where active management is a lot more valuable than just, passive exposure through like strategies, through like ETFs and those types of benchmarks, right? Because you don't want to over-index to, Turkey, for example, right now, right? Or you don't want to under-index to Argentina. So I think this really makes sense to take active management and look at people that are doing the homework on the ground. I think it makes a lot of sense.
No, perfect. Thank you both very much. We'll move over a little bit here to Mauricio on a question. Earlier, we were talking about a story about AI and how it's affected education. Now, within education, especially, the outreach, you think it's going to affect education in a negative way, and also, albeit if it will reach also underdeveloped markets, for example.
Yeah, so within education, I think it's going to be a lot like with fintech. We've seen AI boost fintech, especially in Latin America, and I think we're going to see a similar dynamic in education, where you're almost going to see so in developing countries, for example, you're going to see a technological leapfrogging, if you may, from a place that lacks the infrastructure, maybe the resources, the teachers, jump from that to having education through different means, through AI, through cell phones sometimes. I mean, we saw that again in fintech. People couldn't bank because there was no resources, no banks, and we went from that to now 80% of Latin American adults have a bank account or a debit card. So I think it'll be a similar dynamic. And something in education we were talking about earlier, we're seeing also the integration of AI, of something called BCI. It's brain-computer interaction, which you're seeing, it's freaky and amazing at the same time. You're seeing implants, basically, using AI into people's brains, where they're helping kids, that might have a learning disorder, correct that. So the potential there, that's down the road, but the BCI that's happening, so the potential is massive. I think within education, within fintech, it's incredible, and a lot of it it's already starting.
Perfect. Thank you very much, Mauricio.
Can I just add on that, because I think there's an interesting inflection point now with education and AI that's happening. I think we're starting to see more and more studies that it makes you dumber, right, as you use it. In fact, there was a really good study that came out a few weeks ago from MIT that shows that prolonged use of chatbots actually cognitively reduces your functionality. So this is a big problem with education, right? Because if kids are using it, they're not going to develop, right? I mean, if you looked at, this is a bit of a tangent here, but London cab drivers, for example, back in the day, they used to have amazingly developed spatial memory. So the portions of the brain that were developed to, that are dealing with spatial memory was highly developed in cab drivers, because in order to become a London cab driver, you had to know the entire city in your head. You could not look at a map, right? That was part of the requirement to be a cab driver. So we know that nowadays our spatial memory is less than what it used to be, right? I used to find my way without my phone. Now I can't. I'm pretty sure that if I did a check of my brain now versus 15 years ago, my spatial memory would be a lot less developed, right? So this is a huge problem with kids, right? My guess is that what's going to happen is that there's going to sort of be, a time in school where they're not going to be allowed to use chatbots or like LLMs at all. Neil Ferguson actually talked about this. He called it the cloister, where kids would, for about 7 to 8 hours, would not be allowed to use LLMs or chatbots, and would have to do sort of old school didactic kind, oral exams, reading textbooks, and then a period where they actually use these chatbots to perform real life functions, because we know these things are extremely helpful. So you can't also cloister children entirely from them. So there's going to have to be a balance. I don't know where it's going to land, but I know that that's going to happen. So I'm sure that it's going to impact the education stocks, for example, at some point. But it's interesting because we're sort of figuring this out right now as we go along, right? So who knows exactly where it's going to end up.
So I have 3 kids, all below the age of 7. I have a lot of work ahead of me. It's what I'm hearing here. For Melissa, do you favor right now corporate debt over government debt based on the stories of LATAM?
I've on the risk of being repetitive, I would say you gotta favor fundamentals first. Like currently in terms of EM debt, I wouldn't want to have exposure, for example, to sovereign debt in Colombia or sovereign debt in Brazil because of like literally the fiscal stories worry me too much. Even if we're seeing a little bit of improvement in the figures for Brazil where debt has started to stabilize and we're actually seeing a narrowing of the deficit, I don't think it's enough. Like the compensation, for me personally, in my point of view, it's not enough. And for Colombia, I wouldn't sleep soundly at night knowing that the government is just willing to spend more, just because they're not hoping or they didn't put in the work to actually manage the budget to fit into what was supposed to fit for achieving compliance to the fiscal rule. So in those specific situations, I wouldn't feel comfortable. However, if you look at other, let's say a little bit more successful stories, for example, Peru, you would say, okay, things are a little bit chiller here, for the lack of a better expression, mind my very colloquial English, but things are not as stirred as you would see in other geographies. Probably I wouldn't feel as uncomfortable adding sovereign debt there. Again, in corporates, I'm looking more at fundamentals than I am just a relative value. Because, if we look at, for example, where spreads are trading currently, everything is very tight. There is a risk that we're going to see a little bit more tightening of spreads. But I am, again, trying to position everything more in a fundamental way that I am trying to look for relative value catches.
Thank you. Next question, I'm going to divide it up actually in 2 because this is a good question. It's a simple question. I'll first start with Mauricio. In terms of equities, what would you stay away from?
Ooh, that's a great question. I'd say right now, looking at a value trade, I wouldn't chase. What do I mean by that? There's a company that just IPO'd, CoreWeave. I think it's an amazing company. I think it's an awful stock right now. So I would stay away from the overvalued stocks. Why is it an awful stock? Because it's up 500%. Before today, it was up 500% from the IPO. Amazing company on a pullback. Maybe you step in. For now, I stay on the sideline. So that's what I would stay away from. Don't just look at the company. Look at the stock. Look at the valuations. Look at where it's trading. A company that I love is Palantir. Right now, I'm afraid to chase it. We have one misstep in the market. It can come down. If it comes down, I'm a buyer. But I would focus on that. I would focus on the highly valued stocks.
Thank you, Mauricio. On the same thread, I'm going to go back to Ahmed. Ahmed, in terms of geographies, investable assets or asset classes, where would you stay away from?
So generally speaking, just to sort of keep it very broad, I like equities in the West, don't like debt in the West. I like debt in the East, I don't like equities in the East. That's sort of our general framework. And what I mean by that is I'd rather own, a Chinese government bond, for example, in renminbi than own a Chinese stock, let's say longer term. But I don't want to own a U.S. Treasury, but I do want to own U.S. stock, right? So generally speaking, what we're doing is we're sort of gearing things. We're buying equities in the West, and in the West, Japan is, for example, a Western country, despite it not being geographically in the West. So, Japan, Europe, the U.S., Australia, Canada, places like that, but not buying bonds in these countries. With the exception of countries like Australia and Canada that have better debt dynamics. But buying sovereign debt in Europe, in the United States, and it just doesn't make much sense to us. I don't think you're getting paid sufficiently for this, and you're not getting the sort of, you're buying an asset that longer term is losing value. Let's put it this way. If you would have bought, in 2015, if you would have bought a 10-year Chinese government bond, and you would have bought a 10-year U.S. Treasury, you'd be up a heck of a lot on that 10-year Chinese bond. You would have lost money on the U.S. Treasury. And I think that dynamic will probably continue for quite some time, right? We have to have an adjustment in the West. I don't know where it's going to come. We could get the Deutsche, there's a, so I did a talk a few weeks ago down in the Southern Cone with the ex-head of the Central Bank of Uruguay. And he was, saying how horrible the U.S. debt dynamics were. And he actually had up every other major Western country up there. And with the exception of Germany, I mean, the other ones look terrible or worse than the U.S., right? So the U.S. also has a little bit of, it's the cleanest dirty shirt out there. It all looked horrendous. It looked like a Greek tragedy in terms of debt. Now, if you actually read Greek plays back in high school, if you think back, like there was always a Deus ex machina, which is literally translates to God outside of the machine that would come in and clean it all up, right? The potential Deus ex machina that could clean up this problem is AI, right? And it's very real. And we actually saw this not too long ago. If you guys remember, in 2010, California was about to go bankrupt. In fact, they almost did. And then all of a sudden, they IPO'd all the big names that you know, and problem solved, right? They fixed their finances right away because they filled their coffers with a bunch of tax revenue that came in from all the newly minted billionaires and millionaires in California. That could happen. That could happen. So I don't want to say that that's sort of out there. That could happen here because, we do see massive productivity coming here. And, a company like Meta, for example, Meta could, collectively, the Mag 7s, they're spending around 64% CapEx increase, right? Payroll, 2%. These people aren't hiring people. They're just building more and more bots. And they're making more and more money. So, you put this multiple on Meta, for example, based off what? Based off last 10 years? That's not what the next 10 years at Meta are going to look like. Meta could have 200 employees in 5-10 years. That's it. And make 3-4 times as much money as they do now. What's their PE then, right? So, we have to be careful not to be backward looking with this stuff also.
No, and actually, stay right there, Ahmed. I have one last question that follows through that same thread, and it's within developed countries in Asia, which are of interest?
Well, we really like Japan. We think we're very interested in Japan. In fact, we just increased in some of the strategies we managed. We increased our, especially with the tariff noise at Japan this past week. Japan took a leg down. We were like, let's buy some. Let's buy some more because we already had the position unhedged, right? Because we wanted in yen because the dollar is still expensive, somewhat expensive. It's 10% expensive, so you could project over the next 10 years you'll lose 10% on the dollar. But the yen is super cheap. Really cheap. It's about 40% cheap, below where it should be. So, if you want to own these Japanese assets, you don't want to own Japanese bonds because remember, it's a Western country, even though it's in Asia. Japan, you want to own Japanese equities unhedged. You want to own them in yen. Like, you don't want to own them in another currency. Yeah. So, Japan's one we really like.
Interesting, great. Now we're gonna go a little bit more on the LATAM side. Melissa, I have a question. What is your opinion on Pemex?
Pemex is the perfect example of a company that does not have strong fundamentals, but since it's an SOE, it is fortunate enough to always have the government behind to go on and save it. I don't have the figures fresh on the back of my mind, but unfortunately for the company, what we have seen in the last couple of quarters is a company that is unable to generate revenue, or let's say to generate an operating cash flow that is solid. They continue to have a cash flow burn. Their refineries, specifically Dos Bocas, is still not functioning the way that it should. And last I checked, they were still having issues with some of their providers that they had not been able to pay to. So even if they're able to solve some of these things, I don't want to be that much of a pessimist, but it is just a big amount of red flags coming my way. I understand that a lot of people would like to have exposure to Pemex tactically because of the very attractive yield that the company offers. But if you want to have exposure to oil in Latin America, why not have it in Argentina? I'm not saying that Argentina has better fundamentals as a country. Again, I am looking at corporate fundamentals. And if you consider the development, for example, of Vaca Muerta Sur, this big actually basin that is being led by YPF, Vista, and Pampa, with the collaboration of some other companies that are also invested in there, you actually have a little bit more of, let's say, room for growth and development that you would have, for example, in the Permian Basin, which is where both Ecopetrol and Pemex have exposure to. So if you ask me very bluntly, the math does not math for me, specifically for Pemex. I always expect this kind of question because I've been very bearish Pemex for a long while already. So it's almost like a running joke, right?
Yeah, I mean, I feel like Pemex is not a company you invest in. Pemex is a company you trade. You trade it when it gets, like you buy it when it gets very cheap, and you sell it once it rebounds. You sort of trade Pemex. I don't think you invest in Pemex. That's kind of the framework that I use with it.
Interesting. We've gotten a lot of questions, and we'll have one last one, and then we'll wrap up. But a lot of the missing questions, we'll make sure that we answer them either to your financial advisor or we'll take them afterwards at the cocktail hour. But last question, Ahmed, really quick. Within the big, beautiful bill that was just passed, not to get political, especially here in New York, what do you think are the effects, not only for the economy, but also for the markets?
Well, I'm not going to also get into the political choices that were made on the one big beautiful bill, but I will say the fiscal impulse seems to be pretty front-loaded. So I do think we will have a positive fiscal impulse this year. It's one of the reasons why we think growth is going to come out okay. I think it tapers off as the administration's time in office dwindles. So that fiscal impulse will reduce over time. It's again, we're staring at a fiscal deficit around 6.5%, right? That is not sustainable in the long term. And I don't know when the market's going to wake up and say no mas to the U.S. government, but they will at some point. I don't know when. It's impossible to say when. So at some point, the U.S. government is going to have to reckon with its debt dynamics. Now, that doesn't mean that this cannot last a long time, right? Japan has a debt to GDP of over 240%. So the U.S. at 100% today still has a while to go if you think about it that way, right? Now, Japan has a curious situation where there's a lot of domestic demand for Japanese debt, which doesn't exist in the United States. But guess what? We're starting to create artificial demand for U.S. treasuries. So we're definitely trying to do what Japan did. If you notice, what's a stable coin, right? Which, by the way, if you read our report, we have a whole section on stable coins. Stable coins are going to create artificial demand for U.S. treasuries. So people are going to have to buy treasuries in order to have stable coins. We're talking about a sovereign wealth fund in the United States. Guess what? That's going to buy a ton of treasuries. So we're also creating artificial demand for treasuries, partly because we see our precarious situation, and we're like, because remember what Trump is trying to do, and what Trumpism is trying to do, right? Let's put it this way, because this goes beyond Trump. This will outlive Trump. Is essentially weaken the dollar, and we've done this several times. Okay, so let's also not sit here and be like, oh my God, what's happening? In 1984. A few blocks from here, we got every government that mattered at that time in the Plaza Hotel, and we're like, guess what? We're devaluing the dollar, and you're all going to have to do it. And everyone was like, okay. And that was the Plaza Accord, right? Remember that. So we did that. The difference is that now, our relative power is not what it was back in 1984. So people are pushing back and screaming, but we're devaluing the dollar, right? I mean, and this is sort of the thing that, if you read a lot of the media, you think it's like the end of the world. Right? It's not. The U.S. has defaulted on its debt, and people still own treasuries. I see people go like, what? Like, what do you mean the U.S. Yeah, The United States defaulted on its debt in 1972. No one likes to mention that, right? But Richard Nixon in 1972 said, guess what? You can't exchange your treasuries for gold anymore. That's a default, okay? It's not we stopped paying the interest, but we took out the collateral. That's a default. Any other company or government does that in the world, and they're going to bankruptcy court for a default. But the US Treasury, Nixon did it, no one said a word, right? People still kept owning and buying treasuries. So it's not the end of the world until it is, and then it doesn't matter what you have in your portfolio anyways, right? So, point is that let's all kind of take a step back, because everyone, this year has been like, we have calls all the time with clients, we have conferences, and everyone thinks it's the end of the world. It's not. We've seen all this before. There is nothing new under the sun that's being done, right? So back to my point, right? So the US is trying to devalue the dollar because that makes our exports more competitive. Well, what's the reducing the current account, which is what we want to do, means you need to reduce the capital account surplus, right? Well, if the capital account surplus is going to go down because foreigners are going to want to buy less US assets, guess who's going to have to buy those assets? The Americans are going to have to buy those assets. And partly what's happening is that we're creating markets where those assets now have to be held by domestic institutions or domestic individuals in order to make up for this, because, oh wow, we're at 100-something% debt to GDP right now. If the current bill continues, we're staring at around 130% debt to GDP in 10 years. That's, World War II levels, right? Without fighting a world war. So yeah.
Perfect. Thank you very, very much. Thank you, Ahmed, Melissa, Mauricio, for all making it up here to New York. I would like to thank everybody here in the group that is here in person, as well as everybody watching us live, our clients, thank you very much, our sponsors, our advisors, and especially all the hidden heroes that basically put this event together. Thank you so, so much for a great event. Thank you very much. Have a great night. And we'll see everybody at the next call and next up to the bar. So thank you very much.